Good afternoon, and everyone, and welcome to today's webinar. My name is Mark Allara, so I'm a director here at Vincents Chartered Accountants and also manage the Morgan's Financial Office at Mount Gravatt. And I'm accompanied here by Kenneth Beanland, who's a equity advisor at the Morgan's Financial Mount Gravatt office. So thanks for taking the effort and time out to join us. Just to give you a quick background on today's presentation. The objective is just to give you a summary of where things are at. I'm going to give you a quick update of where the cash and fixed interest market is. I mean, my presentation is probably not that exciting given the ultra low cash rate environment, but we'll probably have a little bit more focus on where we've been, particularly in the listed fixed interest sector, because that's sort of where we're seeing some volatility in action occur. And then we'll go through, and then sort of where we think things might head forward on that. Kenneth's going to just give you a general market update, and it's going to encompass, just the recent reporting season. I mean, we use that as a barometer of to where the companies have been, looking at their expectations as to what their forecasts are, within their sector and from an economic perspective. So that's a good barometer of where the equity market is. We look at Kenneth's also going to look at the domestic and international economy, so just a quick economic update there. Before he touches on some commodities, mainly the iron ore and oil space, been some core ones, and our currency. Finally, I think, Kenneth, you'll wrap up some investment themes as you see it coming over or unfolding over the current year. So. All right, so just to give you a quick update, clearly we've been in an ultra low cash rate environment. The expectation there is to continue. You've probably heard the phrase "is lower for longer," and I don't think that has changed too much from the cash perspective. At least throughout this year, there's actually, the RBA rate remains at 2%, but it's actually, forecasting for another potential 25 basis point drop or 0.25% drop. Some say 2, but I think consensus is more around the one drop. So, looking at portfolios, we've continued to maintain sort of reasonable cash weightings relative to historical, just because of their volatility and help with some downside risks. Term deposits, look, they continue to decline as the market prices, in that expectation of potential a lower drop. The premium paid to investors on the 1 year term deposits above a 1 year swap rate continues to erode. In that space, 1 year swap rate sort of around 2.21% at the moment. In term deposit space, we're sort of seeing around the 30 days, 2.25 out to sort of 180 days, around 3.1%, depending on the institution and the various durations there. The government bonds, look, it has been volatile, and we expect this to be an ongoing trend throughout this year. It's obviously dependent upon the views on risk on or risk off in global markets. We still retain an underweight call given the retail investors particularly can access term deposits at either comparable or more attractive returns, up to that 250 level where it's government guaranteed. So, recent times, they're still at ultra low levels, but we're seeing a slight increase in yields due to the risk on in recent months in global markets. The fixed interest space, look, security prices have been sold off aggressively over the end of the quarter, 2015 through to maybe around February this year. We've been recommending clients take advantage of this weakness and build positions in the quality asset ones. We've been doing a lot more bank debt, bank hybrids as opposed to corporate debt. Just because of where we see the regulations there and relative to the return relative to security. But certainly we've seen over the last couple of months, people build in those positions, and as we've seen an increase in capital value there on some of those, as the yield comes down. So to understand where that sort of market is, I mean, if we have a quick review of where things have happened over the last 12 months, you know, we sort of declined across the board, and in you know, the ASX 200, the index falling just over 2%. You know, the major banks, you know, a bit mixed, but still an average decline of close to 5% over you know, the last year. Looking at the indexes, the All Securities Index shed 3.4, similar to the Hybrids Index. You know, it fell 4.2, and the Debt Index, you know, is around 3% decline. So when you're looking at particularly the Hybrid Index, you know, a lot of support more around the short-dated securities as they sort of have a either reset to higher margins, or they've got the ability to you know, get their $100 face value back and either take that or roll into a new security. You know, talking about those index capital values, that's not incorporating the actual income off those, just the movements in the face values of those. And you know, bonds, you know, reasonably flat, you know, at 2.3% over the course of that year. Some events that are taking place, you know, this year, we've seen a couple already in April, but you know, we've got a few coming up in June with you know, Westpac. You know, we're expecting, you know, particularly the bank ones, you know, as they come off, you know, to their call date or step-up dates or whatever that trigger may be, you know, we're expecting them to issue new Tier 1 hybrid securities. And so we've seen that, you know, saw that with Commonwealth Bank recently, and expecting that theme to continue. There's some other comments there. I won't go through them, but you know, Origin's obviously been under pressure. You know, we've seen some volatility in that. We saw that go down to you know, approximately $90, you know, from a face value. But when they came back to the market to provide some more surety over their access to capital, you know, we saw that, and you know, we're starting to see a bounce in the oil price, a little spike. We're starting to see that move back up a lot higher, you know, close towards its face value. Looking into government bonds, look, I guess you know, it's something that we've tried to do is you know, government bonds obviously offer a you know, broader diversifications, particularly you know, if we've got volatility in equity markets. So when we've got that uncertainty there, yeah, if the risk, global markets, if the risk is off, you know, we're seeing you know, compressions in yields and increases in face values on those. And if the risk is on, like in recent times, you know, just starting to come through, we're seeing a you know, a slight movement in yield expansion, and obviously the converse of that is the potential capital decrease in value. Yeah, there's some good Australian government bonds given direct exposure on CHESS these days, so that's one way to look at it. As mentioned previously, you know, been a flat performer, but even though it's a flat performer in that, from a diversification point of view, you know, there's still a case there. I suppose, you know, with that though, our concern is, you know, we probably you know, cover that with a warning about, you know, just potential capital movements, you know, if you know, risk on continues, and if we see global markets maintain that risk on and growth occur in global markets and economies, you know, there's potential for greater yield expansion in those and movement in capital values downwards. What's been happening in the Tier 1 hybrid issuance, you know, that was the bulk of it with the, your banks. 2015 was a big year, as long as 14. You know, of the 5.6 billion in 2015 raised, 4.7 billion of that was actually the bank Tier 1. So, and not really expecting that to change throughout the course of this year. We can see there's some maturing ones with ANZ and Westpac. We've seen Commonwealth Bank move on that recently, so expecting that to continue. Corporate issuers a bit scarce. You know, they can access the wholesale bond markets or bank debt, given where the funding levels are at the moment. as opposed to the bank tier 1 hybrid issuance, which are more aligned in themselves, that have that capital equity trigger for the Basel requirements there. By comparison, you can see 75 billion of Commonwealth government bonds issued. We'll continue to look at that, and then when they mature and refinancing, and review the rates at that point in time relative to the market to see whether they offer an attractive diversification to the portfolios. Within the, we've mentioned the volatility around the hybrid market throughout 2015. A lot of that, the result of the equity raisings that's undertaken by the major banks. It appeared that when we saw the weakness in the hybrid market, that occurred the same time as the equity, around the same time as the equity raising. So, the expectation there was, a thought process there is that, people were selling the hybrids in order to fund some of those equity raisings. So, a lot of that, prices generally stabilised pretty quickly post that, and have for the time being continued to do so. So, where we're sort of heading at the moment, and we've already seen some of this unfold. We've seen security prices historically trade between 6 and 8% of the face value there, or the $100, the par value, over the last 5 years. The debt securities have performed better, but purely because of their mainly because of their senior rankings and the cash margins. So the hybrids actually attract potential higher yield, but they incorporate the imputation credits, being a frank distribution. Even with that volatility, we're seeing them move back to the face value when they come to their call dates. That's obviously part of the contributing factor that the shorter dated securities have been better supported in the market. I think the tier 1 appeal, it actually does. They do actually look better because when you're looking at the security rankings, the fact that the banks have actually raised a lot of equity actually bolsters their core capital levels, which actually sort of from a security ranking point of view, looks to create a greater buffer between any potential equity capital trigger activities versus as to where they're sort of sitting at the moment. So the greater the strength in that area, the I guess the perceived lower risks there. Some specific comments about a couple of securities. As mentioned there, the trading margins continue to move tighter, so we're starting to see some of that reversing. Which we expect to continue. We've seen it recently. The CBA or CBAPE, they did a listing recently at 5.2%. Given where the trading above $100, that gives a spread of about 4.9%. So we've seen a slight contraction in that credit spread. And we're expecting, if all things being equal, the risk on into the market, we expect that to potentially continue. So when some of the new calls of ANZ and Westpac, we might see some of that come in a little slightly lower. That being said, we still do like those shorter dated securities. When we're factoring in the investment itself, we're looking not just at the cash yield but the yield to maturity, because you're getting an uplift in the market value of that security coming back to the $100 face value. So that contributes to part of your yield, albeit there's a timing issue until maturity. But so when we're looking at an analysis of a particular security, that shorter data security gives you not just a cash yield but the uplift into the face value, the capital movement there. So NAB's got one at the moment. It's trading around 96 or close to 97. Yield to maturity or yield to call of about 6.9% at the moment. So those type of securities. Macquarie got Security, again, out to 2018, yield around 7.4. So if you're a little bit more assertive or aggressive, then you can add that to your portfolio. It's 4% above a 180. So we've got a fair value on that of about just above $100, $100.80. The 180-day bank bill swap rate's in there about 2.46%, so 4% margin on that, plus the any movements in capital value. There's a few still older ones, the non-Basel III compliant notes, so they don't hold the non-viability capital equity triggers, and we're sort of looking at there's some ANZ, NABs, and Westpac ones there, because they're shorter dated. The yields to call of with ANZ 3.9, NAB 4.1, and Westpac 3.8. We think that they're still reasonably attractive. Obviously, in that there, NAB's 4.1%. It's got a higher yield compared to other securities. So, but we're still looking for the shorter dated securities. Total return there as a reasonable prospect for looking to generate income in this ultra low cash rate environment. Look, it's supposed to be sort of a bit of a summary. So, I guess what we're trying to say is, look, feel free to contact us. Look at the research. We just don't push the prospect of a high yielding debt. Investors need to accept the risk attached to the yield. So the higher yielding, obviously, there's a higher risk component to it. So look at that diversified portfolio, and consider the risk of some lower yielding securities for the benefit of diversification, lowering the overall risk of the portfolio. Other ways to do that: look at different maturity profiles, different industries, and understand the complexity of those issuers. There are different triggers and different aspects that really do need to take into consideration. It's not they're not vanilla in their structure by any means. Australian ratings, look, they provide the credit ratings and some complexity indicators. But by all means, feel free to contact us should you want to go through that. Finally, Morgans do offer a summary of each security. They have a fixed interest weekly, which covers all the issue details, credit consideration, commentary, the historical performance, and even with those that potentially got mandatory convertible or capital note conversion conditions, the research can go through those triggers and play it out as to the mandatory converted date, whether they pass those tests, and also with the that non-viability equity trigger as to what is the actual maximum conversion, and use the conversion test to look at whether the issuer share price declined by a certain percentage before any capital is at risk. So there's plenty of data and resources available, and on that note, we're happy to provide some more assistance in that area. Look, we're still taking a longer-term approach. Still adjusting positions where we can. We've been mindful of the costs of actually adjusting versus the benefit of the yields there. So ultimately, looking to make sure financially it makes a lot of sense, which is probably assumed given. Where we can put some government bond exposure, we'd like to, but we've been mindful if there's continued risk on approach, then if there is that global growth and occurring, then there's potential risk attached to some bonds on a capital value as we see yields expand. Again, just recapping, term deposits, look, in this environment, they're reasonable relative to the risk. We're seeing most of the yields come in that, we're using the bank tier 1. They continue to look attractive. They've raised the money, and some of those margins are pretty attractive. So there's a few there in that space you can look at. But on that note, I will hand it over to Kenneth to give the equity market update.
All right, so I thought I'd just do a quick start. Towards the back end of 2015 and 2016, we've definitely seen increased volatility in our market, and it's basically been one news event after another. First off, it was the Federal Reserve raising 25 basis points. Then China's devaluation of the yuan caused everyone to think that that China was in trouble, and then that in turn, with the US dollar, has seen a commodities rout. Up until mid-February, hedge funds were coming out and they were shorting everything linked to China, which included our market. But on around mid-Feb, the data wasn't there for a China crash, and the vast oversupply issues weren't there for the oil space, and we've seen a risk-on rally. So since then, we've seen big rebounds in energy. International markets have substantially increased, particularly the US, which is about 3% off its highs, all-time highs. And this risk-on trade has carried through to our market. So we've significantly bounced off our lows. But I think the thing to remember at the moment is that volatility is not a new phenomenon. This is part of investing. And at this current stage in the world economy, we think it's here for a while to come. And this is because we're living in abnormal times. If you look around the world, you've got the biggest economy in the world looking to raise rates gradually, but then on the flip side of that, you've got large portions of the developed world in negative rates, and this could go deeper if growth of inflation doesn't pick up. So what we're seeing is slight changes in global sentiment or economic data is causing large shifts in this extreme environment because trades are so crowded. So I thought I'd just pull up a little slide here done by our analysts, and I think the slide sums it up pretty well. Look, when you start seeing these sort of headlines, the sell everything, panic, it's most probably the worst thing that you can do is to sell, because it's when this happens that the rebound, or that you should be at least holding, if not chipping away at quality names during these times. So look, these headlines aren't anything new, and I'm sure you'll see them again, but it's just best to remain calm in these sort of environments. So I thought I'd pull up a little comparison. So the top half of that slide is what we presented last year and what we were seeing, and then obviously the bottom is what we're looking at now. So look, mid-March, early April, look, we were looking at the fundamentals after reporting season not supporting the prices of stocks. So the premium that some of these companies were on were quite well above their 10-year average, and what we were focusing on there was a short-term risk to the downside, but again we're long-term bullish on the ASX. So if you fast forward 12 months, what we've seen is the P's contract to inside a normal range historically, thereabouts for most sectors, and the reporting season that we've come off was slightly better than anticipated, and so we're also seeing what looks to be a bottom in the commodities. Not suggesting that there won't be ups and downs, but it looks like our market's sort of basing itself. So on to the actual reporting season. It was a reasonable reporting season for February. It was nice to see more consensus beats than misses. It's always pleasing. And it's also pleasing to see that the multiples have come back considerably. So we're starting to see a little bit of value emerge in some of these sectors. Obviously, resources have since popped, but are still looking a bit expensive. And another thing, and it is always good to see that businesses are trying to drive down costs, but what we're seeing is that's where the earnings growth is coming from, and it hasn't been a large organic growth reporting season environment. So that, look, where we see our market is fair value at the moment, or around these levels. But we would like to see some earnings growth not coming out of cost outs emerging. Look, another sort of pretty big issue that's looking like it's stopped is the dividend increases or special dividends. Look, that was throughout this reporting season, and yes, we still have the banks to go. They report in May. But it does look like this cycle has stopped. So you're sort of looking for the defensive utilities to keep on expanding those sort of those dividends. As I said, banks are yet to report, but it's shaping up to be a pretty important reporting season for the Big Four. I think people will be looking at their interest margins. I'm sure you'll be hearing about bad and doubtful debts in the news, and this is actually a pretty crucial segment because we have seen some large companies like Dick Smith, REM and Peabody over in the States, which our banks have exposure to. They've all gone into liquidation. So look, you most probably will see a little bit of an increase there because they are coming from historical low levels. Dividend cuts, this will be high on everyone's mind because they're obviously part of everyone's portfolios, but I don't believe that the case that it will be the case that dividends will be cut. And I think there's a much greater chance of dividend reinvestment plans or further equity raisings down the track. I think that'll be the way that the banks go if they need to raise more equity for the Basel III compliance. For us, I think for the banks to be really put under pressure, you'd need to see a sustained increase in the unemployment level, and that would start to put pressure on residential mortgages, which is the majority of the bank loan assets, but that hasn't been the case, and I'll just touch on that shortly. But we see them as quality companies, and when these equity raisings or dividend reinvestments happen, you can chip away at them. So, look, just on to the domestic economy. We've actually seen a pretty good GDP number flow through. It hit 2.8% for the December 15 quarter. And what's also pleasing to see is that this growth was actually spurred by the services sector and not the mining. So it looks like the transition seems to be working from a mining-based economy. I suppose a good trend that we've been seeing is the unemployment numbers. So as you can see there on the graph, we've actually been in a nice decline since about July. So hopefully that will start putting a bit of pressure on real wage growth. So that has been a bit of a laggard. We've actually, in real terms, real wage growth has gone down 1.2%. So hopefully, once this unemployment ticks down further, there'll be more competition for employees, and this should spur wage growth. On a caveat to that, I suppose, is with this happening, we still think that the RBA will cut at least once, and this is due to the fact that inflation is stubbornly lower than the target range of 2%, and inflation came out for the quarter just as we were doing this, and it was negative 0.2. The forecast was 0.3, so I think that will increase the chances of a rate cut. Just onto the US. Look, they're in the middle of their reporting season, and what normally happens is that the analysts, which have had a steep decline in their expectations for earnings per shares before the results, and this happens all the time, put out their earnings, and then they're eroded. And what happens is then the company's surprised on the upside. So it's not a new phenomenon. It's happening at the moment. We saw BHP. They were forecast for a loss, and they ended up with a $500 million profit, or thereabouts. And while we are bullish on the States for earnings upgrades in the second half, with the earnings per share erosion expectations beforehand, they're actually not as good as what the market is making them out. So the recent rally that we've seen in the last month or so in the States isn't being supported for the fundamentals at the moment. So there might be a little bit of a pullback there, but longer term we expect in the second half as wage growth grows and inflation picks up, and we'll see the back end of some earnings growth through those companies. On their unemployment, they're actually tracking around 5%, so it's pretty close to their natural rate of unemployment. And much like I was saying for the domestic economy, once you hit this sort of level, employees, there's more competition for skilled workers, so it should entice these employers to give wage increases, and this should help pick up inflation in the States, and that's where we see the rate rise happening over there. I suppose just on this, we think it prudent to position for the recent sell-off in the USD, so we actually think in the second half the USD will get stronger, and so we're looking to pick up some domestic companies with offshore earnings. Now, just touching on back to abnormal times. Now, I'm not going to cover Japan, but Europe and China are both economies that are definitely in that sort of abnormal times for monetary policy. Inflation and growth have been persistently low in Europe for quite some time, and so the ECB recently this year expanded their QE program and increased negative interest rates. So what that means is they're now buying non-financial bonds, and they've also started a new initiative to lend to non-financial corporations. So our chief economist thinks that this is exactly what's needed to pick up inflation and growth in Europe. But of course, there are some risks involved in negative interest rates, especially if these start to get passed down to consumers or corporations. So, something to watch there. China, obviously, one of the biggest monetary expansions ever done, and they did additional stimulus earlier this year. I think what needs to be put into perspective is, in January and February, when you were hearing that it's the slowest growth rate of 20 years, which is currently around 6.9%, that this is off a tremendously large base. So that graph down below shows the Chinese GDP in US trillions of dollars. So a 6.9% rise is actually a fantastic number for the world's second biggest economy. The issue that we see that could loom large in the second half is more about their domestic Chinese corporations that have accumulated foreign debt, particularly in the US. So if we start to see a large increase in the value of the US dollar or a large devaluation of the yuan, it's going to put pressure on some of these high debt or high yield corporate bonds, because they're just not going to be able to repay their loans if they're in USD. So that's something to watch out for, as it could spur a little bit of a pullback in commodities. Look, just a quick one on commodities. The there's been a strong seasonal bounce in oil. Look, it's been very welcome for us. We didn't see oil dropping as far as it did. You might see a retracement because there is still talk of oversupply issues, but we see that abating in the second half. And the main contributor for this is the fact that we see these US shale oil producers that have been producing at a loss to try and keep volume up. They'll have to eventually start rolling their high debt, and we don't think people will start to take that up if oil stays down around this level. So I think that will be the catalyst to see a rebalancing in the supply side there. And another one that's had a massive rebound is iron ore. I mean, it's gone from the high 30s to $70 in a matter of months, a few weeks. Look, this has been great obviously for the iron ore miners, but we remain cautious on this particular commodity. We would suggest staying away for the mid-cap pure plays. We don't like that space, and definitely prefer the diversification of BHP and Rio, purely because it's got such healthy margins, even at the lows. So that's the way we're playing that. Look, just thought I'd touch on the currency. Look, our analyst did an interesting seasonality graph on the AUD, which is in the bottom left. I thought that was a pretty opportune time because the dollar has surged in the last month, and surprisingly, it's very strongly correlated to commodities. So look, as this has been a risk-on carry trade. Commodities have ticked up. I think a big fact that might not get mentioned as much is the fact that our bonds are yielding 2%, and while most places around the world you're now paying the government to hold the bonds, I think overseas investors have seen some decent yield, and that was when our currency was lower. So as our currency's pushed up, I think you might see this unwind, purely because they don't want to see currency depreciation. And we're seeing this being sort of reverting back to our fair value of around $70. Sorry, 70 cents. So again, we're playing this by buying the domestic companies with offshore earnings. Look, just a few sort of themes going forward. And how we're positioning. Look, we think with this resources drive, the quality defensives have lagged a little bit. So for income investors, you're looking at Telstra. It's not too much growth there, but it pays a solid yield. And they've just sold down some Asian assets, so we think there's a chance for capital management initiatives there. Obviously, Ramsay Healthcare is a defensive healthcare stock that we like. Looking at sort of the global fund managers, Magellan in particular, we think that while the volatility has hurt these sort of companies, the fund flow in for Magellan over the next 5 years, we think will be material, and obviously go towards their performance and fund under management base fees. Looking to position for some domestic tourism. We see our dollar lower for longer. We like Mantra in this space, and Sydney Airports, which also I suppose comes into the utilities section, on pullbacks. So I mean, it's a bit expensive at the moment, but if you see a 10 to 15% drop, you try and just chip away at that name. Yield in this ultra low rate environment still looks good. So again, just accumulating the banks, I think you'll get a chance there with some equity raisings coming forward, or a dividend reinvestment plan, and some of the industrials and utilities on pullbacks, because they are a little expensive at the moment. But I'll just flick through to oh, there we are. Just the healthcare space as well. A little cautious on the federal budget, but I think in an election year it won't be too savage. Liking Sonic, Regis, and Ramsey, all quality names. The one to pick up for yield investors there is the Sonic, but that's pretty much how we're playing it at the moment. I just thought I'd touch on our Acrobat model portfolios. We run a few 3 models out here. Income, growth, and balanced. So if you're after income, obviously we're trying to get a better risk-adjusted yield than the market. And then if you're after earnings growth, then you go into the growth. But if you're happy for balance, then we run that one as well. At the moment, 2 out of the 3 are outperforming. The balanced one is underperforming by 1%, and this is due to a bit of an increased weighting in the banks and a larger exposure to BHP. But we're still happy to maintain that level at the moment. We are maintaining higher than usual cash levels, just in volatile times. We think that's appropriate. So I'll just hand back to Mark.
All right, thanks, Kenneth. Thanks everyone for attending. As it's only meant to be a summary and an update, if you require further details or if you require a review of your position, or if we can help with any other services that may feed off it, by all means, feel free to contact obligation free. Other than that, enjoy the rest of your afternoon and the long weekend.